Welcome to The Explainer. Today, we're diving deep into the engine room of professional trading, using Colin Bennett's classic, Trading Volatility, as our guide. We're going to pull back the curtain on two huge concepts that pros use to read the market's mind. To actually measure its fear, its hope, and what it expects to happen next.
Right? We all see stock prices bobbing up and down, but that's just the surface. So the real question is, how do the pros actually quantify the feeling of the market? How do you put a number on nervousness or calm before it turns into a big rally or, a crash?
Okay, here it is. The answer is found in the options market, and it's seen through two incredibly powerful lenses: skew and term structure. Now, these aren't just buzzwords, I promise. These are the actual tools traders use to get a much, much richer picture of what the market is really thinking. So here's how we're going to tackle this. First, we'll look at these ideas as the market's own fear gauge. Then, we'll decode that famous volatility smile. After that, we'll look at volatility over different time horizons, see how these two ideas are totally linked, and finally, we'll touch on how traders actually use all this stuff to play the market's mood. So let's start with the big picture. I want you to think of skew and term structure as the financial world's super sophisticated weather radar. But instead of tracking storms, it's tracking fear and uncertainty. First up is skew. And to really get a handle on skew, we need to talk about something traders call the volatility smile, or maybe more accurately, the volatility smirk. To put it really simply, volatility skew is all about the price difference between buying insurance against a market crash versus making a bet on a huge market rally. It tells us, plain and simple, which direction the market is more worried about. Now check this out, because this is a perfect visual for fear. That red line there, that's what high skew looks like. You can see it's not really a smile, it's lopsided, it's a smirk. The implied volatility, which is really just the price of an option, is way higher for those options on the left, the ones that detect you if the market falls. It means people are willing to pay a ton for downside protection. And this right here, this tells us exactly why that smirk exists. It's basic supply and demand. There is this massive, unending demand for hedge from big investors who need to protect their portfolios. And that demand just pushes up the price of those protective options, which creates that steep, downward-sloping curve we see pretty much all the time. Okay, let's move on to our second big concept. So we've talked about different price levels with skews. Now let's talk about different time horizons. This is where term structure comes in. Term structure is basically a timeline of expected choppiness in the market. It's asking, is the market bracing for a hurricane tomorrow? Or is it forecasting clear skies for the next month with maybe some turbulence expected way out next year? It's literally the market's volatility weather forecast. And it behaves in pretty predictable ways. Normally the curve slopes up because the distant future is always more uncertain, right? But in a panic, the fear of right now just skyrockets, and that curve can completely flip or invert. And this part is absolutely critical. That behavior is directly linked back to skew. The term structure for those low-price protective options is usually sloping down because a big drop tends to happen suddenly, all at once. Okay, so we've got skew and we've got term structure on the table. Now for the most important part, seeing how they are really just two sides of the same coin. They are completely 100% connected. Which brings us to the main event. We know investors are afraid of a fall. That's what creates the skew in the first place. But what happens to the entire volatility surface across every price and every time horizon when that fall actually happens? This chart just says it all. Take a look at the graph on the left. When the market drops 10%, the implied volatility for an option at a fixed price doesn't just go up, it launches into orbit. This is that classic fear spike that traders are always watching. And here we have the absolute key insight from Colin Bennett's book. He says that when markets fall, that fear spike is not spread out evenly over time. The panic is concentrated right here, right now. The near-term volatility explodes way more than the long-term volatility. So here's the magic link. Let's put it all together. A market sell-off causes a massive spike in short-term fear. What does that do? It flips the term structure upside down. That's called inversion. And at the exact same time, it makes the volatility smirk even steeper. You see, they're two parts of the exact same fear-driven reaction. So if you can wrap your head around that dynamic, how do you actually trade it? Let's take a quick peek at how professionals use this knowledge to get positioned.
Well, the pros aren't just guessing. They use some pretty complex models to predict how this entire volatility landscape, the skew, the term structure, the whole shebang, is going to shift and change as the market moves around.
Two of the most common models are called sticky strike and sticky delta. The sticky stripe model basically assumes volatility is pinned to a specific price, like you put a thumbtack on a chart at the $100 level. The sticky delta model is way more dynamic. It assumes volatility moves with the market, staying attached to a relative level. They're just two different theories about how this whole landscape behaves. And this chart is a great look at that sticky strike model in action. See how the green line, the vol for one specific price, is assumed to stay put? But as the market itself moves, the definition of at the money moves with it. This means the overall volatility does still change because you're moving to a different spot on that fixed volatility smirk.
But here is a real gem, a true professional's insight. You might think, okay, skew is high, fear is up, I'll just bet on that. But it's not nearly that simple. There's this sort of hidden cost to holding these trades, what the book calls skew theta. It's like a slow leak in your tire, and it can make a trade lose money even if your view on the market was spot on.
So let's zoom all the way back out. What have we learned here? That skew and term structure, they aren't just abstract charts for quants. They are a living, breathing map of the market's collective mind, a direct readout of its fear, its hope, and its expectations.
And that really leaves us with one last question to chew on. If skew truly is the market's fear gauge, a real-time indicator of what investors are willing to pay for protection, what do you think it's telling us about the market, right here, right now?